In March 2019, Daniel Mercer had $480,000 in his investment account. By November 2021, he had $61,000. He didn't get divorced. He didn't get sick. He didn't lose his job. He just made the mistakes that wealthy people make. Not beginner mistakes, not stupid mistakes, the sophisticated ones, the ones that feel like smart decisions right up until they aren't. And here's the thing, Daniel was a financial analyst. He knew more about money than 99% of people. That's exactly why it happened to him. Today I'm going to show you 10 traps that catch people after they've built real wealth. Not how to start saving, not how to invest your first $1,000. You already know that. This is about what comes after and why it's far more dangerous. Lifestyle inflation, the silent account killer. Here's a number that should scare you. A person earning $150,000 who saves 30% builds wealth on $45,000 a year. A person earning $250,000 who lets their savings rate drop to 15% builds wealth on just $37,500 a year. The higher earner, making 60% more, is actually building less wealth. This is lifestyle inflation. And it doesn't feel like a mistake. It feels like a reward. The promotion comes in. Suddenly you need a car that matches your new title. The bonus hits. The kitchen renovation finally feels justified. The portfolio had a great quarter. Why not book that trip you've been postponing for 3 years? Each decision alone makes sense. Together, they quietly dismantle the engine that built your wealth in the first place. The gap between what you earn and what you spend that gap is everything. It's the entire game. When your income rises, decide in advance what percentage goes to lifestyle and what percentage goes to building. 50 over 50. 70 over 30. It doesn't matter which split. What matters is that you choose deliberately instead of letting the spending just happen. Protect that gap, like your financial life depends on it, because it does. Complexity that costs more than it earns. As your wealth grows, people start showing you opportunities that require a diagram to explain. Private equity, hedge funds, sophisticated tax strategies, insurance products with 17 moving parts. And there's a voice in your head that whispers, "Simple strategies are for beginners. You're not a beginner anymore." That voice is costing people fortunes. Research consistently shows that the average hedge fund has underperformed basic index funds over most time periods. Alternative investments often carry fees that eat the supposed advantages whole. Complicated tax strategies frequently cost more in professional fees than they save in taxes. Here's the real reason complexity is pushed on you. It justifies higher fees. It creates dependency. It makes it nearly impossible for you to evaluate whether you're actually getting value. Before you add any complexity to your financial life, ask one question. What specific problem does this solve that a simpler approach doesn't? If you can't answer that clearly, the complexity is serving the person selling it, not you. Confusing a bull market with skill. In September 2020, a man named Ryan Caldwell had turned $40,000 into $190,000 trading tech stocks during the pandemic boom. He quit his job in January 2021, convinced he had figured out the market. By August 2020, sophisticated debt leverage that feels smart. When you had little, debt was the enemy. You paid off credit cards immediately. You saved before buying. Debt felt dangerous because it was. Now, a different kind of debt becomes attractive. Margin loans against your portfolio, securities-backed lines of credit, borrowing against appreciated assets to buy more assets. The pitch is seductive. Why sell investments and trigger capital gains when you can borrow at low rates? Why use your own cash when leverage lets you deploy capital more efficiently? Here's what they don't show you on the way up. In a rising market, leverage makes you look like a genius. In a falling market, it can erase you. A 30% market decline becomes a 50 or 60% loss in your equity when you're leveraged. Margin calls force you to sell at exactly the worst moment. The same mechanism that amplified gains now amplifies losses, and losses have a floor at 0, while gains are theoretically unlimited. The wealthy people who stay wealthy through market cycles almost universally use less leverage than they could. They've watched leverage destroy people smarter and more experienced than them. If you use leverage at all, use it sparingly, only with assets you could survive losing entirely, and never to the point where a major market decline would force liquidation. The goal is still being wealthy after the next crash, not maximally wealthy, assuming markets never fall. Optimizing the wrong things. Tell me if this sounds familiar. You spend 2 hours finding the best cashback credit card, saving maybe $200 a year. Meanwhile, your investment fees are quietly draining $4,000 annually, and you haven't looked at them in 3 years. This is reverse penny wisdom, and it happens because small expenses feel controllable. They're visible, tangible, satisfying to optimize. Large expenses feel fixed, complicated, overwhelming. But the math is ruthless. 3 hours optimizing a credit card, maybe $17 per hour in savings. 3 hours reviewing your investment allocation, tax efficiency, and fee structure, potentially $1,000 per hour or more. As your wealth scales, your attention needs to scale with it. An extra $80 saved on groceries is rounding error compared to properly managing the tax implications of a concentrated stock position. Audit where your financial attention actually goes. Then ask honestly, does it match the scale of what you've built? Becoming the family bank. When you had nothing, nobody asked you for money. Now they do. A cousin with a business idea, a sibling in a temporary crisis, a friend who just needs a loan until things stabilize. Your instinct is to help. You remember what struggling felt like. You want to share your good fortune with people you love. But financial help without clear boundaries often harms both people. The receiver frequently becomes dependent rather than building their own capability. Studies show that financial assistance without accountability often enables the exact behaviors that created the problem in the first place. And for the giver, one loan becomes many loans. One gift establishes a pattern. Saying yes early makes saying no later feel like betrayal. Eventually, you're dreading family gatherings because you know someone will approach you. If you give money to family, give it as a true gift, not a loan. Be clear, it's one time. And only give what you can genuinely afford to lose, because statistically, you will. You are not obligated to share your wealth with everyone who asks. Setting limits isn't selfish. It's what allows you to help when you choose to, without being slowly depleted. When the number becomes the point, at some stage, something shifts. The habits that built your wealth, saving, investing, living below your means, stop being tools and become the identity itself. Your net worth becomes a scoreboard. Up feels like winning, down feels like failure. The number becomes the goal instead of what the number was supposed to enable. People in this trap keep saving aggressively, long past the point of genuine need. They deny themselves experiences their wealth could easily fund. They achieve security many times over, while missing the life that security was meant to protect. Here's a hard question. What's the actual difference between $2 million and $3 million in invested assets for your real, daily life? Practically almost nothing. Both provide more than enough for the comparison that never ends. When you had $20,000, you didn't compare yourself to millionaires. The gap was too wide to feel relevant. Now that you're at $300,000 or $700,000, you're closer to people with significantly more. They're in your neighborhood, your professional circles, your social feeds. And the comparison becomes toxic in a way it never was before. Your house feels inadequate despite being objectively great. Your vacations feel modest despite being genuinely enjoyable. Your steady investment approach feels boring despite reliably building real wealth. The person with $10 million feels behind because they know people with $50 million. The $50 million person feels behind because they know people with $500 million. Billionaires compare themselves to other billionaires. There is always someone richer. The comparison never ends unless you consciously end it. Define enough based on what you actually want. What income funds the life you genuinely want to live? What net worth gives you real security? When you define enough clearly, reaching it becomes possible. When comparison defines it, reaching it becomes impossible by design. Gambling with money you can afford to lose. I can afford to lose this. That single sentence has destroyed more wealth than almost anything else. Yes, you have a cushion now. A bad bet won't destroy you, so why not take some chances? So you put $60,000 into a friend's startup money you can afford to lose. You take a concentrated position in a volatile stock, the upside is huge and the downside is survivable. You gamble on a new crypto token because it's only profits from investments you already made. But here's the thing, that $60,000 you lost speculating? At 7% annual returns over 20 years, that's not $60,000 lost. That's nearly $235,000 lost. That's the future those dollars would have created. And these